Hello, this is Domenico Composto with Easynomics, and today we're going to look at natural monopoly, how to graph and analyze it as we would on an IB paper exam. First, how would we define natural monopoly? It is a single firm that can produce for the entire market. Essentially, the firm is the industry, and they are able to produce at a lower average total cost than any two or more smaller firms that would potentially enter this industry. Natural monopolies have extensive economies of scale. So as we're going to illustrate, we're going to illustrate a market demand, which I'll label D2, and we'll see that at D2, it intersects with the long-run average total cost curve at a point where minimum efficient scale has not been achieved. So that means that demand can continue to increase beyond D2, and the natural monopoly can increase output while still lowering average total costs. Some examples of natural monopoly are water companies, gas companies, electricity distribution companies, cable television, and railroad companies back in the late 1800s. So back in the late 19th century, the railroad industry was an example of a natural monopoly, because you might have two towns, town A and town B, and we would like for a railroad line to be built between these two towns. So what should we do? Should we have 1, 2, 3 different railroad companies building those lines, or should we just have one? Maybe one railroad line comes in, railroad line firm A, they build that line to connect these two towns. But would it make sense to have another company building a train line between these two towns, firm B, and another company building a railroad line between these two towns, firm C? That would not make sense. That would be a waste of resources, because one firm can meet the needs of society in terms of improving the transportation between town A and town B. We can get goods and services and resources just on one railroad line. That would be sufficient. More than that would be an overallocation of resources. So we call it a natural monopoly because it makes sense that just one company is providing this good or service. Okay, and that could be said. This could be said for electrical companies, water companies. One electrical company is sufficient to lay the cable lines between different apartments and commercial spaces within a town and within a city, within a state. We don't need multiple companies laying water pipelines and cable lines between different apartments. It would be like you going to your bathroom and seeing 3 different faucets from 3 different companies and deciding which water company you're going to use on that particular day. One company is sufficient to provide water, electricity, natural gas between homes. Some other notes. Natural monopolies are not always natural. We should also keep in mind that new technologies can come in, which can reduce costs of production and the cost of building the infrastructure to enter this industry. And eventually that becomes the case. So one example of that is space exploration and space technology. This was originally the domain of governments. Governments had a natural monopoly over spending public tax revenue on building rockets, launching satellites into space, etc., because the costs of production were so high, and private investment would not be able to generate a profit at those high costs to make it worth their while. But now that we see that that's no longer the case, now we see private investment in space exploration and rocket building. SpaceX, as an example, Virgin Galactic, Relativity Space is a company that 3D prints rockets, or is in the process of building the 3D printers to achieve that. So thanks to improvements in technology, private companies can come in and now enter this industry, which was originally controlled by the government as a natural monopoly. We can also say that about telecommunication companies. Telecommunication, laying telecommunication cables between cities, towns, between apartment buildings, etc., was within the domain of one dominant private or public firm. As a result of improvements in mobile technology and information technology, Skype has come in, WhatsApp has come in to dismantle that natural monopoly. Natural monopolies are able to sustain supernormal profit before new technologies come in to allow other firms to come and compete with them. And as a result, we've seen in the past, back in the 1990s onwards, how some entrepreneurs have been able to acquire natural monopolies that were originally within the domain of the government privatizing these firms, and entrepreneurs acquiring them and becoming multi-billionaires because they're now accessing the supernormal profit of these firms. Carlos Slim is an example of that. His net worth back in July 2014 was 80.4 billion US dollars. And this is a result of him acquiring the telecommunication natural monopoly of Telmex. So let's go ahead and illustrate a natural monopoly. Okay. So some notes here. We're illustrating a natural monopoly. And here essentially the firm is the entire industry. Okay. They've achieved significant economies of scale. So we're going to go ahead and draw our X and Y axis. We're going to be measuring quantity on the Y-axis, costs of production, and we're going to show our demand curve. So I'll also show, we'll be measuring our revenue. And since demand is our average revenue, we can also label price. So price, cost, revenue on the Y-axis. If you just measure costs, that's fine for an IB exam. Now we're going to illustrate long-run average total cost significant economies of scale. So that's going to be our LRATC curve. And I'm just going to make a note that at its lowest point, let's assume that this is our lowest point, this is where the firm achieves minimum efficient scale. All right, so this is where LRATC is at its absolute lowest point. Initially, the firm, let's choose a market. Let's say we're looking at the market for electricity. In this market for electricity, we have one firm, one dominant firm that has entered and is supplying electricity to meet the demand at D1. They enter and they have to lay electrical cable between every apartment and an apartment building, between buildings, to commercial spaces, all of those lines to connect to their power plant that's generating electricity, and that incurs significant costs. So the costs of production are going to be very high. They're going to be at C1 to produce enough quantity to meet demand at Q1. Okay? But over the decades, since this firm is a monopolist and sustaining supernormal profit, they can take that supernormal profit and invest in achieving even greater economies of scale. So as they build those economies of scale, their cost of production begins to fall, and that allows them to meet increasing demand as the population of a city, state, or nation increases. So within this particular city, state, or nation, the population is rising and the demand for electricity is increasing, and that's not a problem for the natural monopolist. So demand continues to increase from D1 to D2. They're taking their supernormal profit, reinvesting in building larger economies of scale and building the extensive infrastructure to provide electricity for a rising population. And as they do that, their costs of production decrease from C1 to C2 as they're increasing output to Q2. So this would be it. This is all we would need to illustrate a natural monopoly achieving economies of scale. If you had this on as a paper 1 exam question, first you would want to draw a monopoly, illustrate a monopoly graph, and then second, draw a natural monopoly with large economies of scale to illustrate that the firm is the industry and has significant economies of scale. So let's go ahead and analyze this as we would for a paper IB exam. As can be seen, we have an economic model illustrating a natural monopoly where the firm is the industry. We're looking at the market for electricity, and on the x-axis we are measuring the quantity of electricity being produced by the firm, and on the y-axis we're measuring the cost of production, and as well we are measuring the revenue and price. We have an LRATC curve achieving economies of scale, as well as diseconomies of scale, which is labeled LRATC 1, long run average total cost curve 1. And we notice that we have an initial demand curve at D1 intersecting LRATC at point A, where the firm generating electricity has cost of production at C1 with output at Q1. This firm is generating supernormal profit. They do not face any competition. They also have a fairly inelastic demand curve since they are the only provider of this necessity. So they can raise price, increase total revenue, increase profit, and reinvest profit in building larger economies of scale. So over time, this firm continues to invest in building larger economies of scale to meet an increasing demand as the population of a city, state, or nation that's demanding electricity rises. So over time, we see that the demand increases from D1 to D2, intersecting with LRATC at point B. And we notice that the cost of production has fallen from C1 to C2, while output has increased from Q1 to Q2. We should notice that at D2, the firm has not exhausted their ability to continue to reduce ATC as they increase output. So the firm will be able to continue to meet the demands of a rising population as demand increases, potentially D3, D4, etc. Now we'll also notice that the firm has an incentive to reinvest their supernormal profit in achieving economies of scale, because as they do so, their cost of production falls, their output increases, and this will allow them to prevent a new firm from entering. So if this natural monopolist is operating at point B, their costs of production at C2 are significantly lower than a new firm entering the industry. A new firm entering the industry, for example, at point A, would have significantly higher costs of production and much less output. So the firm at point B is in a better position to lower price, since they have lower cost of production, to potentially put firm A out of business. This would be a type of aggressive tactic that the natural monopolist could use to keep the barriers of entry high and eliminate potential competitors. Build the economies of scale, and if a new entrant comes, they're going to have significantly higher costs of production, so the existing natural monopoly can lower price and eliminate their competition. All right? So those are some of the points that we would raise in an analysis of a natural monopoly. Thank you so much, and don't forget to like, subscribe, or to comment. And that's it. Take care.